My name is Jake, welcome to the channel. In today's video, I want to talk about what every dividend investor must understand. And what you must understand is that there's no such thing as a buy and hold forever stock. Now, before you rush to the comment section and write why I'm wrong, please listen to what I have to say and understand what I'm really saying here. I'm not saying to go and sell all of your individual stocks, but rather I'm trying to help you understand and how to learn how to think about this versus telling you just what to think. And so I think that's really, really important. And by watching this video, you're going to be able to determine for yourself if it makes sense to hold individual stocks and have the mindset of a buy and hold forever, or maybe have a different approach or an open mind to viewing what it means to have a buy and hold forever stock. Now, some of the best videos that I've made here on YouTube are where I talk about buying and holding forever stocks. And, if you want to get easy clicks on YouTube, it's an easy way to do it. You just title your videos buy and hold forever, and people will click on your videos. And the reason for this is that you're playing with people's emotions. The buy and hold forever aspect of it is where everyone wants that. Everyone wants a set it and forget it. And it appeals to every dividend investor. It's the easiest way to invest is you set it and forget it. And it's kind of a dream. Everyone wants that dream scenario where you find that one stock and somebody's telling you that one stock that you can buy and hold forever, and it's the easiest way. And so that's why a lot of people click on it, because everyone wants it. The sad reality is that there really aren't any buy and hold forever stocks because for one simple reason, the facts can change, and spoiler, the facts almost always change. Have you ever heard that term, the black swan event, or this time is different? I have found myself saying that so often here these last couple of years. Now, it's probably because of a once in a century pandemic, right? With that probably comes a lot of, well, this has never happened before, or the first time in 100 years. But it really feels like, and I want you to kind of think, for yourself, have you caught yourself saying more often than not lately, wow, this never happens, or wow, this is a one-off? And I tend to say that a lot nowadays. And it really got me thinking that this idea of this never happens or this time is different is probably not very different, because this kind of thing has probably happened in the past. And spoiler, it's probably going to happen again in the future. Because when you invest in the quote unquote forever stock, you expect everything to work out perfectly and without any issues. But the sad reality is that it doesn't always work out. And it could look a little like this.
He's a very loving cat.
Hang on to us, please. Oh, yeah. Pinky.
Pinky.
Pinky. Whoa. Whoa, whoa, whoa.
Well, we got a wildcat on our hands.
Drop all together.
Yeah, because I'm not going to grab you. Dude.
I think it's got it for next.
Oh my gosh, the algorithms are at it again. I click on what cat video, and now I'm getting like 1 million cat videos shown to me on YouTube. Gotta love it. All right, cool. So I want to talk about something that really helped me when I was a new dividend investor about 7 years ago or so. I came across an article from suredividend.com, and it was titled The 8 Rules of Dividend Investing, here written by Ben Reynolds. Ben Reynolds used to be very active on YouTube, and I would see a lot of his stuff years ago. Their website looks like it's from the 90s. It needs a little bit of an update, but I will tell you, when I was a new dividend investor researching dividend investing, this site, Sure Dividend, helped me so much. So if you can get past the fact that the website looks like it was designed in the 90s, there's a lot of helpful information on this website and in this article. So I want to give a shout out to them, but I want to walk you through something that helped me as a new dividend investor understand the concept of dividend investing, that, dividend investing is great, but it's not without flaws, right? You hear on YouTube, people always talk highly about you. Well, here on YouTube, people either love or hate dividend investing. You probably have seen that. Depending on who you're watching, you're obviously going to get very biased opinions. I try to be somewhere in the center. There's pros and cons to dividend investing, but I want to share with you this article here that really helped me, and that 7 years later, I am still referencing this article. This is how impactful this article was. Okay. And it's titled The 8 Rules of Dividend Investing. I'm not going to read the whole thing, but I want to break down a few of the pieces that I still reference back to. And when I think about the buy and hold forever idea or fallacy that you can buy one stock and never have to look at it again, and it will, that's all you need to do, I think this article is going to help you to learn how to think when it comes to this concept of buying and holding forever and versus what to think. Okay, that's what we're going to do. And I want to share, in a moment here, some examples, and I want you to follow along and understand my reasoning for why I'm saying this. So when looking at the 8 rules to dividend investing here from Ben Reynolds from suredividend.com, he breaks up into, rule number 1 is the quality rule, the bargain rule, the safety rule, the growth rule, the peace of mind rule, the overpriced rule, and the survival of the fittest rule, and the hedge your bets rule. So I'm going to focus primarily on rule number 7, but I want to briefly touch on the others here very quickly. So the first rule is around quality. When you're investing into a dividend stock and a company is paying a portion of their earnings out to you as a dividend investor, as a shareholder, not every company is able to do that, and even fewer companies are able to do it if they're growing the dividend year over year, and especially if they're able to do it in good economic times and bad economic times. This is something that every dividend investor loves, is the quality that comes with investing into dividend growth stocks, or, dividend aristocrats, companies that have grown their dividend for at least 25 years. And the creme de la creme are dividend kings, companies who have grown their dividend consecutively for at least 50 years. And I'll touch on that in a second because it's never a guarantee. And that's a big point that I want to focus on here. The next rule here is the bargain rule. I love this quote from Warren Buffett. The price is what you pay, the value is what you get. The next thing here is the safety rule. The secret of a sound investment in 3 words is margin of safety. So then rule number 4, the growth rule. All you need for a lifetime of successful investing is a few big winners, from Peter Lynch. The next rule here, number 5, the peace of mind rule, is just talking about really volatility and how much volatility are you willing to stomach as an investor. Especially if you're an income investor, you probably are not looking for a lot of volatility, so you're looking for that peace of mind. The next rules here, 6 and 7, are around when to sell. Rule number 6 is the overpriced rule. So this really comes down to, what is the multiple that the stock is trading at relative to its earnings? So what's the PE ratio? If the stock is trading at historically high PE, then an investor may consider trimming or selling a portion or all of their position. The main thing to consider here is the idea of the reversion of the mean. In the short term, anything can go. In the long term, you have what is called the reversion of the mean, and then the share price or the multiple, the PE ratio, usually will come back to historical norms. And so that's where this, understanding when to sell. Rule number 7 is the survival of the fittest rule, and it is, when the facts change, I change my mind. What do you do, sir? And this really is the most important thing. If you invest into a stock and the facts change, well, obviously you can change your mind. If you invested into a stock because you believed in the management, you believed in the market, you believed in, the market that the company was in, and that it was going to continue to grow, if something were to happen and something were to change, and let's say, for example, they're not growing their earnings per share and they were forced to cut their dividend, well, that is a big deal, especially if you're an income investor relying on the income, and especially in early retirement, like myself, for example. That is a big deal. And when that happens, when the facts change, you can change your mind. The last rule, number 8, is the hedge your bets rule. The only investors who shouldn't diversify are those who are right 100% of the time. The sad reality is that no one is right 100% of the time. And people love to quote these great investors like Warren Buffett or whoever who are, right most of the time, or that Michael Burry has predicted 2 of the last 100 recessions that he's predicted. The fact is that no one is right all of the time. And that's why diversifying is such an important part of investing in the stock market, and especially if you're a dividend investor. When I first started investing, I thought the only way to be successful was to only buy the winners, obviously never buy the losers, and be perfect when it comes to buying at the right time and selling at the right time. And I thought that, I knew everything and that I could do it better. I quickly understood that my reality was not always the reality of the future. When we think about what's going on in the world today, it doesn't mean that this normal that we understand today will be the norm in 5 years, in 10 years, in 100 years. So that idea of buying and holding forever, if you're going to live for 80 or 90 years or 70 years, however long it may be, your reality today is going to look very different than it does or will in 20 or 30 or 40 years. And it would be naive to say that the world won't change in those 20, 30, 40 years. And so coming back to the idea of a buy and hold forever stock, I think that that's more of a dream than a reality. Companies come in and out of favor. As companies become complacent, as market conditions change, as geopolitical conditions change, the reality is we just can't predict the future. And that's why I'm saying that the idea of a buy and hold forever strategy with individual stocks is more of a dream than likely a reality. When we look at the sector allocation of the S&P 500 back in 1957, when the index was created as we know it today, you'll notice that information technology was only 3% and financials was less than 1%. Healthcare was just over 1%. Energy was at 21%. Materials was at 26%. The reality of 1957 looks very different than it does today here in 2024. And my argument here is, what will it look like in 2044? What will it look like in 2060? You really want to ask the question, are you going to be able to predict what the market will look like? And is your buy and hold forever stock going to make it without the world or the conditions around it changing? If you look at the breakdown of the S&P 500 today, 30% is in technology. In 1957, it was 3%. Financials makes up over 12.5%, healthcare over 12.5%. Once again, financials and healthcare were the lowest weighted in the S&P 500 in 1957. It's important to understand that the market's going to do what it's going to do. And that's why I talk so favorably about index investing and focusing on market cap weighted indices, because you don't have to predict the future. You get to enjoy the returns. You get to enjoy the innovation of the world. As the world evolves and grows, you get to participate in that growth. One of the reasons why companies come and go is that their moat or their economic advantage dwindles away. A company that is doing well today may struggle in the future as their moat deteriorates. When you look at the economic moat here from Morningstar, you're going to notice that there's different areas that a company can have a moat. It can be in intangible assets, switching costs, network effects, cost advantages, efficiency of scale. These are all great things. And this can be very challenging for companies that are not innovating, or the companies that get disrupted and that they, for one reason or another, lose their competitive advantage, and their revenue starts to decline, their earnings per share start to decline. And once their earnings per share start to decline, well, what happens to the dividend? Well, the dividend generally gets cut first. Before they stop doing share buybacks, before anything else, the dividend gets cut. And once the dividend gets cut, that's usually the nail in the coffin, not always, but usually the nail in the coffin for that business. And once again, we've seen a great company come and go. And that's, I want to emphasize on once again. Here we are again, this black swan event that never happens. Here it is again. Now I want to take just a moment and share a few examples, real examples of companies that have gone through this cycle of what I just described. The first one here is Leggett & Platt, ticker LEG. This was a beloved company for many, many years. They had increased their dividend for 51 consecutive years. They just barely reached the status of dividend king. Here, unfortunately, recently, they cut their dividend from a quarterly dividend per share of 46 cents to 5 cents a share. 5 cents a share. If you've been investing into this company, 5 cents a share, the last time that they paid 5 cents a share was in 1995. 1995. This company lost decades of dividend growth. And if you invested in this company, you effectively lost everything in terms of your income. You might say to yourself, well, this just happened. It just happened. It's a black swan event. Well, let's take a look at another one. This is a little bit different, but with 3M. This was a beloved stock for many. This is once again a dividend king. 3M just recently announced that they are going to be reducing their dividend after the spinoff of a part of their business. They're going to be reducing their dividend from about $140, per share and change, something like that, to 70 cents per share, over a 50% dividend cut on this former dividend king. The next one that is fairly similar is with AT&T. This was a beloved stock by many. Many grandmas own this company in their retirement portfolios. Well, here recently, they spun off a portion of their business and reduced their dividend from 39 cents a share to 28 cents per share. Now, this is not as egregious as the one that we saw with Leggett & Platt and with a few others, where they did spin off the other portion of the business, so you did get the other shares that you could have sold as an example. But nonetheless, it just shows the deterioration of this business model of AT&T, and similarly with 3M, that nothing lasts forever. This buy and hold forever. If you were to go on YouTube and look at old videos on dividend investors or YouTubers or blog posts pumping AT&T and 3M, things have changed. And this idea of this buy and hold forever may be a dream more so than a reality. The next one here is Walgreens. Walgreens didn't quite make the status of dividend king, but here they have recently cut their dividend about 50% from 48 cents a share to 25 cents a share. This is a very difficult business that they're in. It's questionable that they're going to be able to continue growing their dividend. I don't have a crystal ball, but if I were to guess, this dividend is probably not going to go up for years. And the most likely outcome is that it goes down again. But that's me just purely speculating. And it's very sad that just a few years before reaching the status of dividend king, they cut their dividend and something changed. The world changed, or their business model changed. Another example is with VF Corporation. Here recently, they had cut their dividend. Just very, very unfortunate. You saw here that it just slowly was growing. Something accelerated in their business, but unfortunately here in 2022, they ended up cutting their dividend. Another example is with Hawaiian Electric. Everyone knows the tragic, situation that happened in Maui in Hawaii with the fires. Very, very unfortunate situation. Once again, another black swan event, something that's never happened, just happened. And Hawaiian Electric had an incredible track record of paying dividends since, since 1989, I think even longer than that, but just what we see here on the graph. They didn't really increase their dividend year over year, but they had a great track record of paying a great dividend. Unfortunately, the black swan event happened and they suspended their dividend entirely. They no longer are paying a dividend. Another example here with a utility company, Dominion. Dominion recently cut its dividend here with the pandemic, but you'll notice here once again, since the early 2000s and even longer, I believe, if I'm not mistaken, they had been paying a good, healthy dividend, but something in their business changed and they cut their dividend. Another example is with Kraft Heinz. Kraft Heinz is an interesting one here because before it was just Kraft, and then they merged here with Warren Buffett, in 2018, and then they ended up cutting their dividend in 2018. And since then, they have not grown their dividend. Prior to the dividend cut, I was interested in the stock. I actually bought into the stock in 2018. Once they cut their dividend, I sold the stock and I never looked back. Just another example of a company where the conditions of the market changed. These younger Gen Zers, younger millennials, their appetite has changed. Their diets have changed. The days of only eating Twinkies and junk food are probably behind us. These younger generations, they're more conscious about how they eat and their health. And the facts have changed. Last example that I want to share here is with Intel. Most people know the story here with Intel. They have been falling behind. Their innovation has lagged other, similar companies in their industry. They recently cut their dividend. Their share price has recovered. However, the dividend has not yet recovered. It's questionable how they will grow the dividend. But if you were a dividend investor investing in this company, which was a dividend aristocrat with increasing their dividend by, over 30 years, the facts had changed. Now their strategy is no longer on the dividend growth, but rather revamping their business and really coming back to life, which is not really a bad thing if you're a shareholder of the company. They got to cut the dividend. That's what they got to do. But if you're investing in this business for the income potential and the growth of the income, that is no longer the case. Unfortunately, the facts have changed. The reason why investing is so difficult is because we think that the reality that is right in front of us is going to be the reality forever. This idea of buying and holding forever is more a fallacy and a dream than a reality. Recency bias is real. And it's exploited in many ways from other organizations. Political organizations exploit this dramatically. But it's important as you as an investor that you understand that your reality today is not really the reality of 20 years ago. And it's very, very unlikely that the reality of today will be the reality in 20 years. If we look back just a few years ago, when Warren Buffett sold his entire stake in all US airlines, and he got a lot of criticism for this. At the time, we were in the peak of the pandemic. There was peak uncertainty, peak volatility. Warren Buffett came out and said that the world has changed for the aviation industry, that the world changed, and that it's okay to change your mind. Directly after Warren Buffett sold out, ironically enough, the airline stocks rallied shortly after that. They've come back in and fallen since then. But the thing to take away from this, if the world around you changes, it's okay to change your mind. And so if you're a new investor and if you're watching this, what I want you to take away is I want you to think really hard about the idea of a buy and hold strategy. If you're investing in individual stocks, I want you to understand that the reality that we live in today is not going to be the reality that we're living in 10 or 20 years. And with this information, I hope that you learn how to think about this and how to think about a buy and hold forever strategy when it comes to individual stocks. And that is why I talk so much about the core and satellite approach to investing and what I like to call the simple path to wealth with dividend investing, which was inspired by J.L. Collins. What I talk about on my channel is investing in a core portfolio of index funds like SHD and DJRO if your plan and if your goal is to live off of your portfolio. And if you want to add a few satellite positions, individual stocks or commodities or baseball cards or whatever it may be, you can do that. But your core portfolio is made up of high quality index funds that regardless of how the world changes, you as the investor, you will participate in the growth as the world evolves, which will ultimately help you sleep well at night because that's what this is really all about. The buy and hold strategy is about sleeping well at night and not having to worry about your investments. And by following this, the simple path to wealth with dividend investing, I believe your average person will achieve that. I hope that the video was helpful. I hope that you learned something new. If you want to check out more, if you haven't seen this video already about the simple path to wealth with dividend investing, where I talk about the core and satellite approach, I will have that video pop up here and you can watch that video next. Thanks for watching.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.